Part two in our income protection roundtable focuses on the issue of sustainability and whether a more sustainable income protection insurance product can actually marry with a more affordable income protection insurance offering. As part of that conversation, we talk about pricing, exclusions, replacement ratios, and the issues associated with transitioning your clients from the old product to the new. I'm going to come back to you, Adam, and then throw it open to everybody. The whole idea of APRA's IP intervention relates to sustainability. The ability for income protection insurance to be maintained in the future, given the losses that the life companies have been experiencing. The current formula hasn't worked. A huge part of that is pricing. And so, Adam, I'm really interested to the extent that you can share with us what sort of conversations you've had at Zurich with regard to pricing of the new products, and then again back to the advisors straight after to talk about your take on what you're seeing with regard to premiums with the projections or the quotes that you've been doing so far.
Yeah, absolutely, Peter. I think you're spot on there. Sustainability was something which was a clear message from the regulator, and something which we certainly took on as part of our research in designing this new world of income protection products. We really kind of had a look at the existing offering and just thought and tried to work out what were some of the drivers really roadblocking many of the sustainability issues. And we found that and reflecting on, I think, a comment David made around that three-tier definition was certainly one of them, particularly that single duty definition. The fact that someone could be unable to do just one specific duty in their job and perhaps qualify for a full benefit was certainly, I think, part of the issue with respect to sustainability. Offsets, so I know Catherine certainly mentioned this as well, but the fact that benefits could be paid, and often based on someone's perhaps occupation, for example, offsets may not have even entered the fray, and benefits could be paid in addition to other monies that were being received. And part of the message from APRA really was to sort of make sure that this was to sort of be capped effectively. So, that small drop, what appears to be a small drop from 75% just down to 70%, doesn't appear to be much, but really when you understand many of the layers behind that, the offsets, there really is going to be a significant differentiator to what benefits are effectively being paid out, where under the old world, it could be well over 100% of the pre-disability income that's often paid by way of multiples in advance for critical illness type benefits or specific injury events. These sorts of things really were detracting from sustainability in the industry. And just reflecting actually on some of the comments we've also heard, I think Catherine also mentioned, part of the change that she's noticed has been an increase in exclusions. Look, we're certainly party to that at Zurich One Path. So we have applied a couple of extra exclusions in our contracts, but really what we found was that the community expectations piece was quite surprising. When we mentioned to people in the community that there are income protection benefits being paid to people in jail or due to professional misconduct, it really wasn't something that the broader community felt was palatable if they were to form part of that risk pool. So we felt it was appropriate to really try and address some of those issues so that they would pass the pub test effectively.
Okay, so one huge part of sustainability and a competitor, in a sense, to sustainability is affordability, but that's the goal of the entire sector, to be able to deliver a product that serves, that has value, but which is affordable. In your projections, standing behind the actuaries as they run the curves on the pricing spreadsheets, do you think that the new product range that you can get a sense of is actually offering an opportunity for greater affordability, given that replacement ratios are lower and other elements?
Yeah, we definitely have greater confidence that these changes, those which were part of perhaps the hindrance in the old world, will certainly have positive impact on pricing pressures over the longer term. Where I think it's likely to be challenging from an advice perspective is really, how you would then, if you're dealing with a client in that old world product and perhaps cash flow or affordability is part of that strategy or that client consideration, how you then research an existing contract, perhaps apply it through the lens of a new policy to try and address. I really think that's going to be a real perhaps challenge, certainly heighten the need for quality, comprehensive advice, but really one that I think might leave a number of advisors wondering, do we tweak the old contract? Do we perhaps supplement it with the new, or maybe just look at, a new contract in its entirety?
With the new contract itself, do you think it presents opportunities for greater sustainability and greater affordability for the consumer?
Definitely, yeah. We are certainly a lot more confident that the new product makeup certainly is going to be one which is going to be more affordable over the long term.
All right. So thank you for that, Adam. Catherine and Andrew, more sustainable and more affordable?
I'll kick off.
Yes, you got it. Fine.
Yeah. As far as more affordable, I would say initially we're not seeing a huge amount of difference, but that is to be expected. These are the products that are on offer, but what I would expect to see is that the existing products that have been in place prior to 1 October, and of course your agreed value, they will continue to have pricing adjustments, and we'll see a greater divergence in pricing over the years. So, and that was needed. You can't bring in more restricted benefits and reduce the pricing accordingly when the old products had pricing issues. So these products, that's why there's not a great reduction in cost, even though they are significantly more limited compared to what was there previously. And that's what we needed to see. But it really only is one part of the puzzle. I think having the products sustained by the appropriate pricing is a very good measure, but there's still another side to the coin that needs to be addressed, and that is the inflow issues. It's getting, there are less people providing advice, there are less channels for which people can enter to obtain insurance, and we've got things like the protecting your super measures where people are losing their covers in their super funds. So we've got that shrinking pool. So once this side is addressed, there's a lot of work to be done on the other side as well. And both of those measures will address the affordability.
Okay, that's good. So the shrinking pool of advice and the shrinking pool as a subset of
people
advice.
being insured.
So, okay, and so hopefully we'll come back to that, Catherine, because I know you have some thoughts on that. But if I can go to you, Andrew, for your take on affordability and sustainability.
Well, look, I think it's a given that we all want sustainability because we want our clients to get paid when they have to go on claim. So it's no good for us and it's no good for the client and it's no good for the life company if there's no money being made along the line. But, my sort of initial experience, really not having formally written one of the new contracts, but starting to have a look at them for some of our clients, is that I'm not seeing a lot of price difference. And yeah, given if we taken as read that the old products were unsustainable at that level, we probably couldn't, we're just seeing features stripped out and some benefits reduced at a broadly equivalent price from my point of view. So, that's probably why we did write a bit of the old stuff in the lead up to the end of this period, because if you had a look at it and you said, well, if you could get in now at this price or get into this different contract for a pretty similar price, wouldn't you rather be in the old one at that price? Now, yes, obviously that may change over time if that existing book, which is then closed off, gets less and less profitable. I guess we're going to expect to see some increases there, but we took the view that we'll cross that bridge when we get to it with our clients, when we review their situation in the years to come. Again, we'll have to wait to see what the insurers say, but if there's maybe also some path to move from an old contract to a new contract with some provisional underwriting or something like that down the track, that could be something that could ease the pain of getting people out of an unsustainable contract from the insurer's point of view into a sustainable contract. They might look to find a way to make it a little bit less painful to do so.
It would sound a little bit messy at the moment, all a bit up in the air, and if there's a smooth pathway to transitioning from old product to new, that'd be a good thing, Andrew.
Yeah, I absolutely think that would definitely assist, and I mean obviously that recommendation is only occurring if it is in the client's interest to make that move, and I think for most my take on why it would be in the client's interest to make that move in most circumstances is going to be price. Okay
then, David, do you have any comment on that or any other observations you might want to make about observing client best interest? You mentioned RG 175 yesterday.
Yeah, And that's something that Catherine and Phil, we discussed about a week or so ago. Look, for somebody that has no insurance, any product, under RG 175, as long as you are putting them in a better position to where they currently are at, that meets the RG 175 regulation. But what Andrew was saying is, how do we go from an agreed value 3-tier definition to a very simplified product to what it is at the moment? And that's going to be the difficulty. And I guess the only thing that you can really do to move them there is basically on a cost basis. After you've exhausted all your avenues, from chopping off benefits, reducing the monthly benefit, extending the waiting period, moving from agreed to indemnity, stripping it again, then you'll go to this product.
I think, David, just to sort of chime in there a little bit, is from a client point of view, we can go to them and we can say, this is what agreed value is, this is what indemnity is with 3 tiers, this is what the new world is, or, these are the replacement ratios you've got versus the new world. But I think for a lot of them, it's going to go over their head, because you can give them the cost benefit and say, this is what you're giving up for the price reduction. And they're really just going to be saying to the advisor, well, should I be doing that? Is that a good trade-off or not? And I think in a lot of cases, it's going to be borderline impossible to know the answer. I mean, if what they're in is genuinely unaffordable now, and their only choice in order to continue to have some income protection is to move to the new contract, well, then I guess that answers that question. But for anyone sitting in that grayer area, I think it's going to be a lot more difficult for both the client and the advisor to come up with a solution that's right.
Yeah, you're right.
Look, Andrew, actually, you've touched, I think, on a critical element there, Peter. If I could just add something to that, and that is, we thought exactly the same. We have a clear understanding of what our lives insured know, what they value, but really out in the broader community, we wanted to make sure that we understood what some of the real pressures were. And part of our research and discovery in the new IP world was to actually find out what some of the leading stresses were that were happening in the Australian community. And the most common, so the highest personal stressor was actually financially driven. So it was ahead of work pressures, lifestyle, health. It was all about money, all about finances. And that really got us thinking that, and particularly when we looked at research from the medical field, that, any detriment to that financial aspect can actually have a reverse impact on someone's health and recovery, their wellness, increases in mental health issues, depression, anxiety. So the approach that we've taken is very much a financial one that tries to minimize any financial impact right through a claim. So I think if you find that clients are perhaps reaching out to an advisor saying, look, we just don't know, what do you recommend? Maybe reflecting on some of the research which is available, either through us or through other means, just to sort of express some of the issues that perhaps a lot of people are having, so that perhaps clients can actually make a better or more informed decision about perhaps what is likely to be appropriate for them over the longer term.
In part 3 of our income protection roundtable, the panel moves away from talking about sustainability and starts to consider whether the launch of this new round of income protection insurance products can actually represent an opportunity for the re-emergence of risk-focused or risk specialist advisors. And I hope you can join us for that conversation.